So thank you everyone for joining us today. For those who know us, welcome. For those who don't, Adam and I are advisors on the wealth management side of Withum Wealth Management. Today, we are going to spend time walking through our quarterly market update deck. So the charts and economic numbers we're going to cover are some of the data points our investment committees look at when making investment decisions. And we have a fair amount of really good slides we want to show you here. So this is going to be more conversational in nature. So instead of us simply lecturing on each slide, Adam and I are going to hold a fluid discussion, moving from topic to topic. And with that said, please feel free to ask questions in the question box on your screen. We already had a lot of good questions come in, but as we go through, please keep the questions coming, because we will be monitoring them and answering the questions throughout. And any questions that aren't answered today, we will reach out to you separately in a follow-up. So I think we all know from last year, between inflation, interest rates, recession talks, we have quite a bit to fit into the next hour or so. But before we start on the markets, we do have several individuals on this webinar who are not clients. So a quick 2-minute summary about the firm. Withum Wealth was founded over a decade ago to give clients an alternative to the traditional and somewhat outdated Wall Street approach. At the time, leadership felt there was a fundamental issue with how wealth management firms operated. And we ended up creating a white glove service that not only can seamlessly integrate with the accounting consulting solutions offered by our accounting counterparts, which, by the way, creates this very nice round table client experience for any client that wishes to engage us on both sides. But we also eliminated common conflicts of interest in the investment industry to offer what we believe to be a much cleaner advisory relationship. Adam, we were just talking about this last week. Roughly 85% of our industry does not need to give advice that is in the client's best interest. Isn't that crazy? I mean, that means for every roughly 10 advisors out there, 9 of them don't always have to act in your best interest as a client. And a fair amount of the time, the end client doesn't even understand that they're taking advice from someone who is not legally bound to act in their best interest all the time. That's unacceptable to us. And that was one of the core principles from when we started Withum Wealth. Withum Wealth represents the other 15% of the industry. We register with the government in a way that makes us always legally bound to put our clients' interest ahead of our own. We are what's called true fiduciaries. We don't sell products or offer advice on anything that could produce additional profit-sharing revenues for a group like insurance and banking or custodial function. This reduces conflicts of interest. So when we give advice, we want our clients to be able to trust our advice. We don't want our clients to have to take a step back and wonder if we're just disguising advice in some sort of sales tactic. That's not how we work. Now, obviously, there's more to us than just being a true fiduciary. We have highly credentialed staff that help clients plan and invest for every stage of life. And we have institutional level investment reach, giving us an expansive investment universe from individual stocks and bonds to liquid alternatives and private investments. So Adam, I said a lot there. I think I beat the nail on the head enough with this slide. Was there anything I missed?
No, I don't think so. Let's dive in here. I know in the past we've had webinars for clients that we've always had someone from outside of the firm guest speaking, folks that have been on CNBC and whatnot. So I'm excited to show everyone our own internal thoughts, right? Looking under the hood at what we're thinking about as the investment committee and how that plays into the portfolio that we're investing on behalf of our clients.
Right, because this is these conversation points, this is what's directly impacting the portfolios, right? So we have this slide here, and forgive me if I keep looking left, this is where I have my slide deck pulled up. So we have this slide here that shows the performance of global stocks over the last quarter, along with some news titles at the bottom that may have understandably triggered some fear among investors. I mean, Adam, look at some of these points here, some of these headlines. We have wages put upward pressure on already sky-high inflation. FTX, which is a very large crypto platform, files for bankruptcy, potentially triggering losses in the billions of dollars. China bracing for another deadly COVID wave. Yet we still ended the quarter positive. You see the line in the chart here, it's still trending up. I don't know about you, Adam, but for me, this really emphasizes how important it is to keep a long-term focus.
Right. I think day to day, there's any number of things that we can worry about. I mean, just today alone, we had good earnings from, GM. We had bad earnings from Caterpillar. we have a Fed meeting tomorrow. I mean, every day there's plenty to be worried about. What does this mean in the context of someone's portfolio or retirement picture? That's what hopefully we can provide some clarity on for clients.
Right. There's always going to be that risk lingering that could shake you from your strategy, but successful long-term investors really benefit from, putting the noise to the side and really focusing on that long term. I mean, there's the age-old saying, bull markets climb a wall of worry, right? So let's jump in here to look at the different time frames we look at as investors.
Right. So we try to bucket for our clients. We try to bucket three main sort of time periods or ways to think about the markets at any given point in time. So you said bull markets climb a wall of worry. We have here the near-term view at the top of this chart that highlights, and we're going to dive into and dissect a lot of those worries and find out, A, is it something we should be worried about? Or B, is it something, maybe let's debunk that myth and talk about why that's not something to worry about. In the sort of intermediate time frame, if you will, the cyclical view, we call it, from bull to bear market, what are the different themes that arise or get put to the wayside in any given market cycle? The last cycle was US driven, technology driven, growth driven. So far through this bear market and the rally off of the October lows, we've seen different sectors, different regions, and different styles of stocks outperforming. So how does that impact our strategy and what we're doing for clients? And then lastly is the long-term view. This is just really hammering home an emphasis on being diversified, how important that is within portfolios, but also keeping a disciplined long-term view. And you can't get shaken out of the markets. There's, like we talked about, on that last slide, there's always something trying to shake us out of the markets. So let's look at 20, 30-year time horizons and see how that affects our investment decisions.
Sure. So I know we had a lot of questions come in ahead of time about inflation. We had questions come in about, why are bonds and stocks moving in the same direction, which I think after this presentation, people will realize, or at least those who don't already, that they kind of work one and the same. Inflation really has been a root of why certain asset classes performed the way they did last year. So let's start jumping into that. Can you get into some of the inflationary numbers we're looking at?
Yeah, so I can't tell you how many countless articles I read over this last couple of years just talking about the highest inflation since the 80s. This graph right here is really just meant to put that into perspective. Okay, we had really since the 70s and 80s declining inflation, declining interest rates off of this spike. Okay, so this now spike after the COVID lows has come about for a couple reasons, but what is very positive is that it looks to have peaked. Okay, this chart does not include the December data. This chart was put together just after the quarter end. About a week and a half ago, the new data was released for December that shows everything is continuing to trend downwards in the right direction. Okay, so something we're keeping an eye on. The blue line there is what we call the headline number. That includes things like food and energy, which are typically more volatile. The gray line is the core CPI, or the consumer price index. That is excluding food and energy, which is more so what the Fed is looking at. I think it's just important to exclude those two, or be aware of what you're talking about, what measure of inflation you're talking about, because food and energy can go up and down so volatilely. For example, if a drought pushes avocado prices higher, that doesn't necessarily mean there's inflation. Food and energy are much more supply demand driven than actually underlying inflation.
Mm-hmm. And one of the factors, right, that impacts inflation is the money supply, right? You go back to the CFP work or the CFA work, and money supply is part of the formula that results in inflation. So we do look at money supply, right? Can you talk to us a little bit about this slide?
Yeah, so this is just showing the incredible boom in the money supply. I mean, the trend has been pretty consistent throughout history. We have, little bump ups in 2008, 2009, if you want to circle that. That was the beginning of the break in this trend. Yeah, right there, exactly. That was TARP, right? The Troubled Asset Relief Program in 2008, where the Fed stepped in and bailed out a lot of the big banks during the great financial crisis. And then you can see another step up there. In COVID, that was the Fed, both from a fiscal and monetary perspective, right? The Fed was helping out, but the government was also helping out, increasing unemployment benefits, handing out stimulus checks, if you want to call them that. This bump, what we see is money supply tends to lead by about a year or so. Let that money trickle into the system, let the banks loan it out, and bam, summer of 2021, we really started to see inflation pick up. People kept saying transitory, us included, and I think it's stuck around a lot longer than it has. The good news here is that the last 6 months or so, you can see it starting to trend down, right? So this is giving us an encouragement that inflation not only will slow, but return to normal. I think I should say prices are not going to return to normal. I think that's a common misconception that people have. We've written an article about that inflation slowing just means that the price increases will stop going up so fast. You do not want to see deflation, which means that prices would go back down to where they were. That would be extremely bad. That would be something that typically occurs during a recession where demand dries up incredibly.
Right. So I like, let me fix my drawing here. So I like this next slide, especially when fielding questions from clients. There are a fair amount of individuals out there that are still asking or questioning, well, can the Fed really get inflation under control? Is this going to be, back in the 70s, 80s when, inflation was really skyrocketing? And what we're seeing here is something a little bit different, right? It's a little bit more promising.
Yeah, so this chart is fantastic. I love to point this out. I talk about this with my clients all the time. The headline figure, what you read about and what you hear on CNBC, is so misleading in our view. Okay, 7.1% inflation. Yes, the last 12 months of price increases increased at a rate of 7.1%, or I think as of the December data, which is not included on this chart, is around 6.5%. That is true. The last 12 months, prices increased 6.5 or 7.1%, depending on your measure. However, look at this trend. Okay, do you notice a difference somewhere in here? I mean, to the right here on the chart, you can see that since July, inflation has been much more normal. It's only been increasing at a rate of 2.5% to 2% annualized. This is what we want to see. What happened in June, July? Well, the Fed had started to increase rate hikes to their 50 bips. They started to change the tone of what they were talking about, and the market started to respond. Now, they started talking about hiking rates back in about a year ago, maybe 13, 14 months ago, needing to start tightening monetary policy. And we know rate hikes take 6 to 12 months to get into the system. So the market 6 to 12 months later had already started to anticipate inflation was going to come down. And this just shows, as we go further into the spring, let's fast forward to April for a second, okay? In April, the trailing 12 months will not include November, December, January, February, or March. I mean, that alone right there is like, what, 3 or 4% of the 6.5% figure we're talking about? Right. So if inflation does continue to trend down and we get these, let's say 0 inflation to 0.4 inflation, we're going to have the 0.8 and the 1.2 of February and March falling off of the data set and have new months in the future that are coming in slower. And it's only a matter of time before the inflation rate is below where the federal funds rate is. They're projecting to be at 5% by the end of this year. Okay, that would be extremely restrictive policy. And if they hold it there for that long, and inflation is down in the 3 to 4% range by the end of the year, that might not be a good scenario for the economy.
So the answer to the will the Fed be able to get inflation under control question is really, well, what we're seeing is they have, and we're just waiting for the old months to roll off that 12-month picture.
Right. It starts to become a, will the Fed do what they've always done, which is be reactionary and look at the trailing data, or will they be anticipatory and, forecast the fact that inflation has already and is coming down and will, likely stay down? That's the question here. And look, unfortunately, the Fed has always been late. They've been late to hike rates and late to cut rates through every bull and bear and recession expansionary cycle that we've had. So hopefully maybe this will be the time that they get it right. But we have to take a look at that, and we'll talk about the recession or lack thereof in future slides here just in a moment.
And one of the data points, we believe that the Fed is looking at, right, is wage growth. Can they get wage growth to turn over? And it does make sense, right? If people are earning more, right, they don't mind spending more for milk and toilet paper, et cetera. So in order to get inflation under control, you have to start creating headwinds for price increases, which would be people not earning as much, right?
Yes, and this is what the Fed is really worried about. This is not explicitly measured in the inflation data, but we can almost be certain that they're watching it because they talk about it during the press conferences. They talk about wage growth and the unemployment rate. This is wage growth as it's tracked between job stayers, people who stay at their current job and get a raise, versus people who switch jobs and get a raise through, jumping to another company, okay, on the right side here. So we can see that inflation has trended down on the left chart, but this is a little worrisome that it hasn't peaked yet and hasn't started to roll over. Like you said, if a company can get away with increasing their prices 7% because they're giving everyone 6% raises, they can still increase their profit margins by 1%, right? Mm-hmm. So this is kind of that wage spiral that we need to be cautious about. I can tell you, and it's not in here yet, but the next month in the data series actually showed a leveling off of all this data, which is positive.
You start to see this turn a bit in that next data output, right?
Yep, exactly. Now, the other important part about wage growth is it's what we call sticky inflation. It's very hard to take away a raise from someone once you've given it to them. It's very hard to decrease someone's hourly rate once you've given them an increase. The only way for an employer to, if they can't get away with more price hikes on their products or services, the only way to rein in costs is to ultimately end up laying off employees. That's in a recessionary environment where you would start to see the unemployment rate tick up, and that's not what we want to see. So hopefully this can moderate with inflation that's moderating. Everyone can stay employed and prices can stop increasing so much, and so too will people's wage growth. This, I will also note, is catching up from, you can see this didn't really start to turn up and start spiking until 2022. Inflation's been increasing since sort of early 21, mid 21. Everyone was getting back out to normal in that first summer after COVID.
Right, and if you look at most categories of inflation, so on the left-hand side here, right, we have energy in green. That has come down, right? Look how thick it was, and now it's right here. New and used vehicles has simmered down. Really, all of these categories except for shelter, right? Shelter remains a bit stickier than the other categories. We don't have to spend too much time on it, but why don't we just talk a little about that, since that is something we are keeping an eye on.
Yeah, so interestingly, shelter is, housing costs are one of the largest chunks of the inflation subset of data. Okay, so this is worth looking at for us, in our view. What we've done here let me take a step back. Shelter is measured in the inflation data as what's called owner's equivalent rent. What that means is if I buy a house, what do I need to rent the house for to offset all my costs of ownership? So post-pandemic, asset values increased, houses went up, which meant the cost of owning a home went up. Okay, so you can see that big spike there after 2020. What we've done with this data set here is bumped the housing price index ahead by 12 to 15 months. Okay, and you can see these two tend to track each other.
That's the dark blue line we're looking at, right? So this is the jump here.
Correct.
Right? Okay.
Yeah, that's the jump post-pandemic, and we've bumped the blue line forward by about 15 months here in this data set. And you can see they track each other very closely. Rent and housing prices tend to react, rent with a little bit of a delay here, okay? And so what I'm sure a lot of people listening are aware is that housing prices have begun to slow because interest rates are higher, less demand with increased costs, okay? And so we're expecting rent to roll over as well on a trailing and lagging basis. So I think this is really important. Another sort of arrow in our quiver of rooting for inflation to come down. It's going to happen. You know, did the Fed create the housing slowdown? Possibly, you could argue they did. And so by raising rates, and so this rent will start contributing positively to lowering inflation.
And we're not saying that owner's equivalent rent, or, you know, if we just kind of back out the nonsense, the price of homes will start to decrease. We're just saying that the year-over-year increase in price we're seeing to start to slow down, right?
Level off. Yep, exactly.
So one of the things that I think is neat, that I think is off, you know, a lot of people's radar, is how COVID and the COVID environment really impacted how we're dealing with this. One, you know, there's some that can argue that it helped kind of spark this inflationary environment. But then two, you know, answers the question of, well, why doesn't this feel like why doesn't this feel as bad as it should? And, you know, what I think's neat is you see during that COVID environment, this light blue shaded area here, that is excess savings by individuals, right? There was a peak excess savings of $2.1 trillion. Right, and as inflation started to come up, we start to see that excess savings come down, right? Can you talk a little bit about that?
Yeah, so, you know, starting with that dashed gray line along the bottom, that's the historical average savings rate that we've seen. And you can see when everyone got locked up and started getting money from the government, personal savings skyrocketed. We couldn't spend it on anything for a couple months. And many people, even in the summer and fall of 2020, you know, didn't return to normal spending or traveling. You can see it spike up a second time there. That was during the, I think it was the Omicron wave. I'm starting to lose track of all the Greeks. But what you can see is these two massive spikes above trend savings led to that excess of over $2 trillion in people's excess savings. That's been spent down since about the summer of 2021, when demand returned to a much more normal spending spree, okay? I think this is saying that people are overspending and undersaving the last year. Part of that is due to increased costs of inflation, which this is going to be, you know, we've talked about this, you and I, it's sort of a race against time. Is inflation going to come down to a normal level where I can return to my normal saving and normal spending? Or am I going to run out of money first? And what's going to happen? And if we run out of money before inflation gets normalized again, that's not a good thing. People will really pull back on their spending to save more and to live. And that's where we could see a recessionary environment. But if inflation continues to slow, as we somewhat expect, you know, we think inflation could be back in the 2s and 3s by the end of this year, possibly. You know, maybe consumers are actually going to be able to manage this appropriately and won't be putting themselves in too much debt and too much, you know, harm's way, which is what you tend to see before recessions or during recessions, I should say.
Right.
And you can see here on the right side of this chart just shows people aren't taking on more debt or debt as a, maybe they're taking out more loans, but the cost of that debt is no more expensive than it has been over the last, call it 10 years or so. It's really on this trend line there on the right chart. So I think this is really important that people aren't extending themselves despite this inflation yet. That's the key word there, yet. So this is going to be really interesting to watch throughout the summer.
Yeah, I actually presented yesterday to an investment committee for a foundation, and someone asked the question about, people taking on more debt as in a number value, right? And numbers are funny because it really depends on how you look at it. If you look at a chart showing us how much people are taking on in debt, it looks kind of scary. But when you actually, in the right-hand chart here, look at, well, what's the debt as a percentage of what they can cover, right? Their disposable income. It looks pretty reasonable, especially compared to, that 2008 period, right? And what I like about what we're showing on the left here is that race. There's this drama unfolding, right? And I feel bad because we're leaving everyone on this cliffhanger. But if you think about the inflation data, it's pointing to inflation probably being under control in the next 6 to 12 months. Is right. There's a lot of things that can happen in between that could mess it up, but 6 to 12 months. Then we're also looking at, that excess savings is probably going to run out somewhere in the next 6 to 12 months. So what's going to happen first, right? If excess savings bottoms out first, then people may start taking on more debt. We may see that recession. If excess savings doesn't run out, we may see a soft landing, right? Which I don't think anybody really thought we were going to see if we talked 6 months ago.
Right. Exactly. Yeah. I think that's the key factor is that there's still, estimated around 0.8, 0.9 trillion dollars in excess savings. It's going to, if this trend continues, it will run out at some point later this year. But we'll keep an eye on this for sure and notify clients through writings.
So obviously, we're not going to say inflation's under control. What we could say is the data points are pointing to the right thing. But let's assume we've seen peak inflation. What does that mean for stock investors?
Yeah, this chart here is a great one. It looks at different periods in the 70s and 80s, as well as in 84 and 91, where inflation peaked, and just said, okay, let's look at what returns are after inflation peaks. 3 months in the blue bars there, 6 months later in the orange bars, and then a year later in the gray bars there. And what you can see is that stocks like inflation peaking. Okay, the longer time frame you go out, the better return you get. And I think it's important to note that a lot of these returns are above average annualized returns as well. So stocks and companies tend to be able to expand their profit margins, increase their earnings in periods where peak inflation has passed. I mean, it tends to make sense, right? Peak inflation is going to put a lot of stress on people's spending. And if inflation starts to moderate, consumers feel better. They'll go out and feel like they can spend more, and economic activity can pick up. So really interesting to say, okay, we know inflation's slowing. That's a good thing, but how good is it? Let's look at the returns, and here they are. That gives us confidence.
Right. And again, there's a lot that can happen in between, right? So it doesn't necessarily have to play out as historical averages do, but this does point to what you were saying about how, it does make sense after peak inflation, how that could benefit the stock market going out over that next 12-month period, right? So,
and I'll just say, inflation peaked in June. The S&P 500 was at, I'm just looking here, call it 3,600 in June. And today we're at about 4,000. So, that's a decent return if you invested your money over the 6-month period from when inflation peaked until now. Now, of course, this is backwards looking. It's really hard to have that as your core investment strategy, but it's interesting to see this play out again here today.
Right. Okay. So we talked about inflation. Let's talk about what the Fed's doing to combat inflation, because we all know how it does impact, right, at least the bond price of the bonds we're holding in portfolios. So let's talk about the interest rate forecast that they put out.
Yep. So we have a meeting tomorrow. As it stands today, the interest rate is about 4.25% to 4.5%. Right. You can see the 4.4% there on the chart. This is the Fed's projection of where they think interest rates will be at the end of 2023, at the end of this year, at the end of 24, and 25, and then into the long run. Okay. So what this is showing is the Fed expects to hike rates 3 more times this year. This was as of December. Okay. They'll arrive and finish the year at a 5.1 rate. So between 5 and 5.25. So I think what's worth noting is that interest rates do take time to sink into the economy. We talked about that. I think we're starting to see some economic signs of slowdown. Consumers are tightening their belt.
Adam, we're losing your audio here. Just as an FYI.
You're losing my audio here?
Yeah, okay. You're back now.
Can you hear me?
Yes,
all right.
You're back.
Where did you lose me? Technical difficulties. Sorry about that. I was just saying that the Fed expects to be at 5.1% by the end of this year. Hike rates 3 more times. Okay. The difference is that the market is actually expecting something else. So if you can jump slide here to the next page, this wave, if you will, is showing where the market expects the Fed to be by the end of this year. Okay. And there's a difference. The blue dots show 5.1% for the Fed at the end of 2023, whereas the market is saying, actually, we think the Fed's probably going to hike 1 or 2 more times, but before the end of the year, they're going to be cutting rates back down to where we are today. Quite interesting, and a very big difference from what the Fed is saying they're going to do. So we kind of have this dichotomy we have to be worried about, where is the Fed going to do what they say they're going to do, which I will note that that's what they did this entire past year, right? That could be a bad thing for the economy. It would over tighten, like we've said, we don't think they're looking at anticipatory data, just at the trailing data, which could be bad. Or is the market right? People always like to say the bond vigilantes are the smart ones out there. So the bond market is projecting the Fed's going to pivot. You probably heard that term out there. That just means they will sort of ease up on their hard stance about being diligent to hike rates. Time will tell what happens. I don't think we're going to have clarity on this until at least March, possibly by June, to know, if inflation's actually coming back down to where interest rates are. I think they'll loosen their stance a little bit. And, by that point, we might know a lot more about the condition the economy's in. And I think the markets are sort of forecasting maybe a slowdown or recession where the Fed will get easy again with their policy.
Sure. So, and the Fed has moved rates pretty dramatically. I mean, it's impressive. You look at where we were at the end of 2021, so roughly a year ago, right, which is the green line down here. The 1-year Treasury was yielding less than 0.5%. Look at it now, right? It's yielding, it's over 4.5, close to 5. I think right now the 6-month is yielding 4.8%. For those individuals with cash on the sideline, all of a sudden a U.S. Treasury is a much more attractive vehicle to hold your liquidity, right? Because not only are you getting income that's state tax free, you're tend to get more of it than what you're seeing in a savings account. And any money that you put in a U.S. Treasury is going to be backed by the full faith and credit of the U.S. government. When you put more than $250,000 in a bank account, all of a sudden you have to worry about losing your FDIC insurance, right, on the amounts over that. So it's become this great environment, especially for short-term investors or those that want to just sit on cash for a while.
Yeah, that's right. Typically the yield curve being inverted, which we'll talk about in a minute, where the shorter end rates are higher than the longer term rates, is not the best thing in the world. It signals some weakness potentially in the short run, some risk, if you will. But for savers, we think it's a great way to be putting money to work. And I will just note that CDs, money market funds typically do not pay out as much as treasuries. So talk to your advisor if you have excess cash that you're holding on to, if you have CDs maturing. We can talk to all of our clients about managed treasury strategies that we have at our disposal. So, that's a call to action for the audience, if you will. Getting 4.6, 4.8%, I think, on a 6-month treasury is, kind of a no-brainer at this point.
Yeah, I mean, you shouldn't be yielding nothing anymore in your savings account, right? Those days are long gone. You don't have to. So, why, right? You did mention the inverted yield curve. So let's jump to that.
Yeah, so this is just showing historical recessions are shaded in the gray bars there vertically. And this is the 10-year interest rate minus the 2-year interest rate. So once that goes negative, we have what's called a yield curve inversion. It's historically been a very good indicator of a fragile economy. I don't want to say a recession indicator because a yield curve doesn't mean anything that a recession's coming. It's just people saying the next big thing that goes wrong in the economy could send us into a recession. Okay, so this is certainly something to watch. And if the Fed can orchestrate a soft landing, that would be extremely positive. But the yield curve is maybe suggesting that that's a foregone conclusion. So worth watching. We have had false indicators before happen, where the yield curve has gone flat or inverted, and it hasn't led to a recession in the next 6 to 12 months, but something to watch and keep an eye out for.
Right, and what the yield curve is not taking into account, right, is that excess savings that was built up, right? That's not the only factor keeping us out of recession or potentially keeping us out of recession, but it is a factor that the yield curve obviously doesn't see. So
I mean, the famous last words for investors are, this time it's different. And if there's one time you could get away with saying this time it's different, maybe it's post-pandemic monetary behavior. Yeah.
So we talked about the yield curve changes and how it impacted short-term investors. Let's talk about the intermediate long-term investors. What we're looking at here is the starting yields of the U.S. Treasuries, of a 2-year U.S. Treasury versus a 10-year U.S. Treasury after the month after the last Fed rate hikes. These are all different periods in time. You'll see currently the 2-year Treasury is yielding 4.4%, which is more than what the 10-year Treasury was yielding 3.88%. This is as of January 23rd. So, you do get questions, well, why would I go out 10 years to lock in 3.88% when I only have to go 2 years to lock in 4.4? And so this is what we looked at as a committee here is, well, what does it mean? And if you look at the second box here in the middle, what you'll see is we measured short-term U.S. Treasury performance going 12 months out after that period versus what the long-term U.S. Treasuries are yielding. And what you find is most of the time that longer-term U.S. Treasury, which in the periods that are shaded blue here, right, those are times when the yield curve was inverted like we're seeing now, but you're still seeing outperformance in a lot of these environments, right? Can you talk a little bit about that?
Yeah, and for all the clients out there that have had treasury purchases in their portfolios over the last, call it 9 months since we started doing this, you've probably noticed that it started out being 3 to 6 months treasury purchases. And of late, when those mature, we've been going out and extending our duration to 2 years, 3 years in some cases. And we're in active talks right now to potentially go out even longer, 7 to 10 year time frame. And the reason is, like you said, we can lock in, even if it's a lower number, we can lock in that rate for a period of time. And the importance of this is that when the Fed eventually cuts rates, or rates, do continue, if they continue going down, locking in a longer term rate can have really positive impacts on the price appreciation of that bond. Okay, so when you look at a total return, you can see that long-term treasuries outperform on average short-term treasuries after the Fed is done hiking. And we're not saying the Fed is done hiking today, but at some point they will be, right? So we're going to start extending our duration there.
Right. You're never going to get timing perfect, right? So it's about leaning in and out of, certain areas based on what the environment's calling for.
Exactly.
So great. So let's jump to the other side of the ledger. Let's start talking about stocks, and you can't really talk about stocks unless you really hammer home recession. So let's hop into the unemployment rate here.
Yeah, so this is great. I mean, I like this chart just to signal if we're looking at economic indicators, if we're looking for signals of recessions, that we've never had a recession without the unemployment rate rising at some point, okay? And we haven't seen it materially rise yet. So if this starts to rise, for a couple months, that could be an indicator that we've entered a recession. The unemployment rate, I will say, is a lagging indicator. So let's say unemployment starts rising in June, that could mean the recession started in March, June, maybe today, we'll see. But this is one positive indicator that, a feather in the cap of being bullish, if you will, that we might be able to accomplish a soft landing. Unemployment rate hasn't budged. The labor situation is extremely tight. And that's a good thing if employers don't want to lay people off because they can't find a replacement. People and consumers will still have spending power to keep the economy going.
Mm-hmm. And that's really just one of many economic indicators we're looking at, right?
Yep. Yeah. So this is a economic leading indicators index here that we've charted, and what you can see is down at the bottom are 10 leading economic indicators we look for to signal a recession might be ahead. And this leading economic index has gone negative the last several months, the growth rate of that. This is a concerning sign if you're forecasting a recession, okay? So some of those leading economic indicators are manufacturing. The stock market is a leading indicator, which we'll get into in a minute. But there's a number here that are signaling a slowdown is ahead.
Right. One of my favorite economic or indicators of a potential recession is what we have going on here regarding reporting slowing coincidence indicators in states, and that if more than 50% of the states start to report these slowing coincident indicators, right, a recession has historically been happening, right? We've been there. I think there was one time where that hasn't a recession didn't occur, but it's been pretty compelling, hasn't it?
Yeah, this is a great one. So if half of the states or more are showing a slowdown in economic indicators, coincident indicators, right? So things that slow as the economy enters the recession, that's historically been a sign that the recession is starting. Now, we never know when the recession starts until much later and much more after the fact. But this chart could suggest, if this continues on trend and more states report slowing growth, this could suggest a recession's already started. Although, which we'll see in the next slide, that might not be the worst thing for stocks.
Mm-hmm.
The next slide actually gets into historical recessions and what that means for stock prices. And remember, we said stocks themselves are a leading indicator of a recession, right? So a recession is measured by GDP declining. We've also charted on here earnings and payrolls. So if you'll take a moment and just explain and show the bottoms of each of these things, we start to see a pattern.
Right. So whether it's the Eisenhower recession, we got the S&L savings and loan crisis of 1990s, global pandemic, COVID, the global financial crisis, right? The gold line is GDP. We see GDP bottoming here for the Eisenhower recession. For the financial crisis, GDP bottoming here. GDP bottoming here for COVID. Now, if we look at the blue line, the dotted blue line, that's the S&P 500. Where is that bottoming? That's bottoming here. So before GDP bottoms, and here, right, with GDP bottoming here, or here, right? So we're seeing that the S&P 500, to your point, Adam, right, is looking forward while GDP isn't. And you do get questions from clients. Well, I heard the media talking about, is recession around the corner? Does that mean I should be selling my stocks? Well, if you sell your stocks, you actually may miss out on a good portion of that upside waiting for that recession call, because by at least historical standards, right, you're not going to hear about that recession until the S&P 500 bottom. Now, that doesn't always have to be the case, but historically speaking, that's how it's worked, because S&P 500 is looking forward, pricing in everything in a forward fashion, while GDP is not.
Yep. Yeah. Stocks price in future earnings of companies, right? So if you're in the recession, the future earnings are accelerating and looking really good. So that's why markets tend to do well actually throughout the recession. And we have a chart here on the bottom right. This is looking at the S&P 500 performance after you have 2 quarters of negative GDP. So after you've actually had that contraction, economically speaking, how do stocks do? The returns are great after recessions. And what you tend to see is a big bounce off of the bottom for markets time in and time out.
Look at the 12 months.
Yeah, I think the average 12-month return after 2 negative quarters of GDP is 26%. So that's more than double the historical average return. And this goes out 24 months, 36 months. So, whether we have a recession starting today, it could be a good thing for stocks. The only thing I'll say is we don't know how long a recession might last, how stubborn the Fed might be. If earnings really do meaningfully decline later this year, the bottom for stocks could be still in the future for us. That being said, we are down a lot still from the all-time highs, and historically those have been good places to put money to work for the long term. Okay, so this kind of concludes our near-term worries section. I think this could be a good point to pivot to some cyclical issues that we're focusing on, and then we can harp on some longer-term trends. This one, talk to me about this one, Austin. This is plotting consumer confidence and what S&P 500 returns. Therefore,
so it's asking the question. All right, to investors, how do you feel about the next 12 months of performance? Are you feeling very bullish about it? Are you feeling very bearish about it? As this line comes up, right, investors are feeling more bullish. They're feeling that the next 12 months are going to be more promising. As it moves down, they're feeling more bearish, right? They're feeling more pessimistic about the next 12 months. Now, what's interesting, and it goes to the psychology of investing, is, well, how did the market actually perform over the next 12 months? And what you find is that when we're at peaks, when investors are feeling the most promising about the next 12 months, the average return over the ensuing 12 months was 4%. When investors are the most pessimistic, so at the troughs, when we're bottoming in here, on average, the next 12 months of performance has been 25%. So it goes to show the dynamic of investors getting out of hand typically when they're very optimistic and potentially overbuying and paying more than they necessarily should be for investments or for stocks. And then when they're most pessimistic, they're willing to sell something at a much cheaper price that's actually valued. So it could be opportunistic for investors in bearish environments to be more of a contrarian investor, right?
Yeah, and I think this plays into our role as advisors to our clients. We're, in some respects, we're like behavioral coaches, right? Keeping people grounded when times are really good and making sure that they're not jumping off the cliff when times are bad. And, you can see, you saw it last October, the market was down 25%, over 25% at one point in just a 10-month period. And we were getting more calls than we ever really had over the last several years when times were good. And keeping those investors from, shooting themselves in the foot, so to speak, the market went on to rally dramatically over the next 2 months off of those lows and off of that pessimism. So, I think this just speaks to staying in touch with your advisor when you're feeling a little bit nervous or worried, and getting the entire picture like we're talking to you about today.
Right. If investing feels good all the time, that likely means you're missing out on some of your upside, right? When the best returns are really built into that market, generally speaking, it doesn't feel good to be investing in stocks.
No, and I think, maybe we'll jump to, I think it's slide 33, Austin. This talks to time horizon. I think it's really important for clients to remember that, remember their goals and what they're investing for. Because in the short term, markets can be extremely volatile. This is looking at 1 year periods that you've circled here. The green bar there is the best return ever for stocks in a 1 year period is 47%. The worst return ever for a 1 year period is 39% for the stock market. So very volatile, almost 90% spread of possible returns there. You can see bonds. Bonds have actually had amazing years too, and bonds are not impervious to losses. Bonds have, that might be this past year, down 13%, but bonds can be volatile in the short run too. But let's look, unless you're 80 or 90 years old, even retirees and people getting ready to retire still are likely going to live 20 plus years. Okay. So I think having this time frame and being grounded is important, that when you look at 20-year periods here, okay, stocks have been as high as 17% annualized over a 20-year period. The worst, and I think this is really crucial to hit on this part here, the worst 20-year period of returns for stocks was 6% annualized. Okay.
Not even negative.
I think a lot of people would take that.
Yeah, not even negative. It was a positive. It wasn't a very high number, but it was 6%.
That's right. Stocks have never had a negative 20-year period of time throughout history. So, and you can see actually the average annualized return of bonds is 5.5%. So the worst ever stock market 20-year period still beat what you can average on with bonds. And I think this is really, worth highlighting, and it's worth focusing on the long term with our clients, having those goal-based conversations of needing cash flows and growth, and how much cash flow they need and how much growth they need, and using the stock portion of your portfolio as more of that sort of asset accumulation bucket, and using the bond part of your portfolio to the degree you need both stocks and bonds as more of that sort of that ballast in the storm, so to speak, that we've experienced this past year, for example.
Right, and what investors found over the course of last year is, right, there's multiple buckets. There's stocks, there's bonds, there's even alternatives. And the alternatives that we did add to certain portfolios when they made sense, did add some valuable diversification benefits. So, I would definitely encourage you to sit down with your advisor and ask them about these buckets, because they're there, right? We're implementing these approaches for you. We're trying to build an all-weather portfolio that is geared towards many different types of investors and tailored specifically to you, the end client. And if you ever have any questions about it, definitely pick up the phone and give us a ring. We're here to help you, to walk you through that, and we want to make sure you understand.
Yeah, good summary there. We've got about 5 minutes left. Maybe we'll answer some of the questions that have come in so far. Austin, we had one here on whether gold is a good investment at this point in time, just given the uncertainty out there. Do you want to take a stab at that?
Well, so I know where I'm going to go with this. Gold has a speculative nature hooked into it. I don't think gold is a trade. I think if you're going to own gold, and this is my personal point of view, that gold is a long-term asset, right? To be able to jump in and jump out of gold at the right time is very hard to do, and investors see that. Investors who try it do see that. Sure, you get it right sometimes, But when you look at the fluctuations and the speculation built into that type of investment, it's really tough to trade. I know you have some thoughts. We were talking about this, just recently, actually, right?
Yeah, they're not my thoughts per se, but Warren Buffett would say that you should not own the gold bar that sits in your, safe and does nothing. You should own a gold mining company that produces profits and can increase your stocks and your shareholder value there. It employs people, right? It's productive for GDP. So we've actually own the miners and metals ETF for a period of time as an inflation hedge, and it worked out pretty well for clients over the last year or so. I believe we've started to wind down that position at this point. But to your point, I think it's really a hedge, and most of our clients don't need to worry about hedging if you have that longer term viewpoint. And just like trying to time the markets in the short run, if gold is going to do well in times of panic, you have to, know when to buy it and know when to sell it as well. We're just not in the business of trading for our clients. I think you use that term. We'd rather invest for the long haul and pick up more opportunities, discounted stocks at good prices.
Sure, which is a natural fit to the next question. What are the best vehicles for increasing wealth while also preserving it at this challenging time?
That's a tough one. So you have to take on some risk to get a return. That's called the risk premium, right? If you don't want to take on any risk, you're not going to get any return. And if you take on a lot of risk, you can get a huge return, but you can also lose more money potentially. So I think there's a happy medium there. I would say, what are the best investment vehicles for that? I would suggest this person speaks to their advisor and really gets a plan in place and understands the different pieces of their portfolio and how they're helping them to achieve their goals, right? Everyone wants to make the most money and no one wants to lose money. But how do we do those in a smart way and build a well-balanced, diversified portfolio? That's up to you and your goals.
Right, and that's a great point. Our planning process takes into account the what ifs, right? One of our assumptions is that the market is going to tank as soon as we implement the strategy. And we can look at that and say, well, how does your plan play out over time? Because, we don't want to just assume that the portfolio is going to grow by 5% or 6% or whatever the percentage step by step every year. We want to be more realistic with it. We want to understand, well, when that COVID environment happens or when that 2022 environment happens, how is your financial picture? Because that's really what we're investing for. We're investing for how are you going to meet your goals over time, or what are you going to pass to that next generation? And that planning process can be crucial, especially during the times of panic when it comes to keeping an even head and keeping that long-term picture.
Yeah, absolutely. Well, I want to be conscious of time here. I know we're bumping up on the hour that we had allotted. So I just wanted to take a moment and thank everyone that is still on and listening. This is new for us to be presenting our own internal thoughts, and we just ask that you please reach out to your advisor and provide some feedback on this medium of passing on information. We have the quarterly letters. We have some short videos that we send out from time to time, as well as our Withum Wealth Minute. So we are always curious to hear feedback from you all. If you enjoyed this, if you would like more of this in the future, please let us know. Thank you as always for being clients. Austin, any final words you have?
No, I appreciate everyone tuning in. Thank you.
Great. Excellent. Well, thank you everyone, and we hope you have a wonderful day.